And with that, I'll hand this over to Matthew Frost, who's the Head of Risk Advisory and Regional Leader for Willis Towers Watson, to facilitate this next session and introduce the speakers.
Thank you, Trevor. Ladies and gentlemen, good afternoon and welcome to our session. We're delighted to share our thoughts and insights on climate change and its impact on insurance and capital in the future. On the screen, you'll see the job titles of Liz and Tony, and in the RIMS website, you'll see their bios. So I won't waste any time on that. They are incredible professionals, and it's been a joy working with them over the last couple of years, particularly on this subject. Just a quick personal story, perhaps to illustrate why I've an active interest in this issue. In a former role, I was Vice President of Risk Finance at BHP, and in that capacity, I attended the very large RIMS conference in San Antonio, Texas, back in April 2018. Now, every year, the mining and metals industry hosts a session that takes place on the Tuesday afternoon. And I was facilitating a panel of speakers discussing the state of the mining insurance market. One major reinsurer used the opportunity to announce their intention of restricting their insurance cover from July 2018, just 3 months later, which included no longer writing new thermal coal mines and plants, and any company generating more than 30% of their revenues or power from thermal coal. After that announcement, I asked that speaker one clarification, and that was, does this just apply to property insurance? The answer was no, it applies to all lines of insurance, both on the retail insurance side and reinsurance. And that answer, I can tell you, shocked the 110 people that were in the audience that day. It's also a pretty tough message to hear 3 months out from a liability renewal with metallurgical and thermal coal assets in the portfolio, I can tell you. So for me, that felt like a truly seismic shift in the underwriting appetite of insurers and demonstrated the significant reality of insurers' evolving strategies in the environmental, social, and governance space. Subsequent to RIMS, an avalanche of European insurers announced similar strategies over the course of the next 18 months. And today, the position of insurers on thermal coal and indeed oil sands is assuming political significance. This article you'll see on the screen was in last Sunday's Courier Mail in Queensland, and it begins with the paragraph, major projects supplying much needed jobs in Queensland won't be built, and the economy will suffer if banks and insurers are allowed to keep walking away from backing coal-related projects. I remember saying to my broker after that RIMS conference that this was probably just although a thermal coal position, it may be the thin end of the wedge and would eventually apply to all of coal. Well, actually, the position's probably a bit worse. It's likely to apply to all high carbon emitting companies and industries. So we really need to be aware of this subject today. So ladies and gentlemen, the stakes have never been higher. That's why I'm delighted to welcome Liz and Tony to bring us bang up to date with the state of play. Situated in the heart of London, when they can get in. They are close to all the main insurers and are uniquely qualified to provide us with these insights. So although this will be a presentation, I know there's been different formats during the week. This is a presentation, but there'll be plenty of time for questions, which we welcome. So keep that Q&A chat box going. Liz, why don't you take us away?
Thank you. Thanks ever so much, Matt, and thank you for setting the scene. So I'm really delighted to be joining you today, and thank you for joining the last session of the day from your end. And I'd like to start by taking you back to 2004. It's Friday evening, about 7 o'clock, and I'm standing in a very long line at Blockbuster video rental store. I'm clutching the new release, Day After Tomorrow. I really quite like a disaster movie. And I'm musing over whether to choose the popcorn or the Häagen-Dazs, and to be honest, I will probably plump for both. In 2004, it was Blockbuster's biggest year. They were riding high. They had 9,000 stores globally and were employing over 80,000 people. And their turnover was just shy of $6 billion. And yet, if you fast forward just 6 years, to 2010, Blockbuster had filed for bankruptcy with debt of over $1 billion. So what happened there? Well, I think you probably all know. In short, they didn't recognise the seriousness of the external threats to their business. They didn't recognise quickly enough the opportunities that were available from the shifting landscape. And they didn't adapt their business strategy quickly enough to combat, excuse me, the risks. Now, the climate crisis is much bigger than Netflix, and no organisation is going to be immune. We all need to be aware of the facts out there so that we can make the right decisions for our organisations, so that we can ensure that our organisation ends up a winner. So as Matt said, in this presentation, this is exactly what we're going to discuss. We're going to discuss the shifting focus of insurers and banks and how this could impact your organisation's survival. This is how serious this is, and could impact your ability to even access insurance capacity and capital in the future. And we're also going to talk about the key part that you have to play as risk managers in helping shape your organisation's future survival strategy. So this is really key. So I'd like to hand back over to Tony, who is now going to start by talking more about the challenge.
Liz, and just on a personal note, I remember 2004 going to the Blockbuster in Neutral Bay in Sydney when I lived there. And I still have quite a number of DVDs that I bought as ex-rentals from that Blockbuster there, but it subsequently died after that. Yeah, so I'm going to talk about really the fact that the momentum is building behind change. It's coming, and the size and scale of the change is really, really dramatic. In order to meet the goals of the Paris Agreement, which in terms of mitigation of emissions require us to reduce emissions by about 50% globally by 2030 and get to net zero by 2050. We need to see an emissions drop of between about 7% per annum. And just to give you a sort of idea of the scale of that change, emissions dropped last year globally around 7% due to the COVID pandemic. So it's that scale of change per annum that is needed to actually achieve the goals of the Paris Agreement in decarbonising the global economy. So it's a tough challenge that we're actually meeting. And how do we know it's getting, how much warmer it's getting? Well, the science behind actually predicting how gases actually increase temperature is very well known. It's something that has been actually scientifically proven since the 19th century. And that basically means that we've known what causes global warming. There have been scientific papers throughout the 20th century, but really the momentum behind the science has been growing for the last 30 years or so. And all of the modeling that's been done so far in terms of predicting historic warming has actually fitted with the science. So we're pretty confident on going forward with what the science tells us. And we already know that since the 19th century, when good quality data on temperature recordings was first started to collect on a global scale, that we are about 1.1 degrees above pre-industrial temperatures. Now that means we already know that we're also baking in more degrees of change at the moment, between a sort of 0.2 or 0.25 degrees already because of the emissions, even if we switch them off tomorrow. So we know how much warmer it can get. The latest IPCC report, which is the UN 5-yearly report, which actually brings together all of the science collectively to synthesize into a report, suggests that we have the next decade is going to be crucial, and that we are approaching tipping points where the natural systems will actually start kicking in and adding to the emissions that we are generating as humanity. Now, it's not only what the science is telling us. Change is also coming through the fact that policymakers, financial institutions, and corporations are already ramping up their climate commitments. And actually, I would say corporates have been at the vanguard of this for the last decade or so, with many of the corporates taking the leading positions, some policymakers. But what is really new is financial institutions are really ramping up their efforts, and policymakers are also catching up with that as well. So we're seeing a raft of initiatives aligning to net zero and the Paris 1.5 degree alignment, which is the fastest decarbonisation that most models actually try to model. We're seeing a lot of initiatives in the banking and debt market. The insurance market is also starting their initiatives as well with, for example, the Net Zero Insurers Alliance. Equity has been playing in this space through asset managers and asset owners for a number of years already. Climate Action 100 Plus is a particularly powerful movement there, but also Net Zero Asset Managers Alliance and Net Zero Asset Owners Alliance, and the Say on Climate initiative, looking to vote at AGMs on companies' transition plans and vote down the AGM if the transition plans and targets are not necessarily good enough and aligned to Paris. But what's also interesting is the regulators, principally through the Network for Greening Financial System, but also TCFD and the Coalition for Climate Resilient Investment, are starting to actually look at this as potentially a contagion risk that needs to be managed to the financial system as a whole. So this is really, really new, and regulators are now pushing the individual banks, insurers, asset managers, asset owners to actually articulate what the risks are to them so they can measure the systemic risks across the financial system. Allied to this are a number of tools that are available to help the financial institutions. We're seeing a lot of work through the Glasgow Financial Alliance for Net Zero. We're seeing taxonomies like the EU Sustainable Finance Taxonomy, which also requires financial institutions in Europe to be able to align to. A Science-Based Targets initiative to help companies set targets. And most recently, the Climate Transition Pathways tool, which will accredit companies' transition plans if they are aligned to the Paris Agreement. So I'm going to hand over to Liz now. It's going to take you through where insurers are currently in terms of their policies around fossil fuels.
Thank you, Tony. So to build on the theme that Tony was talking about with regards to financial institutions and insurers really ramping up their commitments to net zero, they're under increasing pressure to do this. And they're starting to recognise the roles that they've got to play as stewards of the climate transition. And they're really getting pressure from all sides. As Tony mentioned, they're getting pressure from the regulators, and I think we're all aware they're getting pressure from investors and activists. So really from a reputational standpoint, we can see that organisations are starting to make decisions so that they're protecting themselves for the future. And initially, these organisations started to look at the impact of their business from a carbon exposure perspective operationally. So, they looked at what within their operation did they need to change so that they could meet their net zero commitments from an operational perspective. And then they were looking at the impact of the investments that they are making as organizations. But now they're focused on the carbon exposure that sits within their underwriting and lending portfolios. And this is the piece that we were talking about today, because this is the piece that really could impact you. So far, over 100 financial institutions have divested from coal, and over 30 insurers have already set out policies to either stop supporting coal completely or reduce their coal exposure in their underwriting portfolio. It's interesting to see that at this point, there isn't any consistent approach to this that's being taken across the industry. So taking coal as an example, we'll see with some insurers that they've taken a very draconian view, and they've said, actually, we're just not going to cover any of that industry. Some, I think it was Matt at the beginning, mentioned that some are saying that if there's a portfolio of less than 30% thermal coal, then they would cover, but anything more, they wouldn't. And some are saying, well, maybe no new coal. And so there really isn't a consistent approach. And a lot of the approaches, they're not necessarily aligned with the science that's needed. It's interesting that as part of my role, I talk with a lot of senior underwriters and also heads of sustainability for the large insurers. And from these conversations, particularly over the last year or so, one thing is really, really clear. This is not going to stop at coal. This is something that is going to go far beyond coal. We're already seeing, and I think yet again, you will be aware, I'm sure, that we've got insurers that are not supporting oil sands and Arctic drilling. And Tony mentioned that UN IPCC report, which is certainly one that's worth having a look at, because they've really put methane in the spotlight. And they've said that there really needs to be clear targets to reduce methane because of its high global warming impact. So we can see that that's going to be coming down the line too. And insurers who were not looking at their carbon exposure a year ago, so people who I was talking to a year ago where this really wasn't affecting their strategy, they are now looking at this. They are looking at putting robust ESG plans in place for their organization. And they're looking at quantifying the carbon exposure that sits in their underwriting portfolio. And they're trying to decide what to do for the future. They might not have a strategy, they might not all have a strategy that's complete at this point, but it's all on it's on all of their agenda. So this is really a key thing that you need to be aware of, because they all want to survive long term, and they know that reputationally this is going to impact them because there will be more and more pressure for them to act as stewards of the climate transition and look across multiple high carbon industries. So I suppose the question is, how could this impact you as risk managers? Well, this focus will cascade across multiple high carbon industries. So the industries that could be impacted, well, they could include marine, aviation, agriculture, steel, cement, just to mention a few. So this could really have a severe impact to you. There could be a severe contraction of capacity for high carbon emitters. And in some instances, we could be in a situation where there is no capacity for high carbon emitters. So this is something that we do really need to be thinking about now, so that you've got robust plans to ensure that you've got a future ahead. And as a risk manager, you really do have a key part to play in mitigating this risk. So I'd like to pass back over to Tony, who's going to talk more about that and to talk about what you can actually do.
So thank you, Liz. There's basically what this is heralding is a number of pressure points that organizations need to demonstrate or react to and take action on. And those pressure points and drivers on driving a transition to low carbon business models, or even zero carbon business models, and in some cases net negative carbon business models. These are the drivers that are really at the heart of where your risk as risk identification and opportunity identification will be important. And really, the risk manager has a strategic role to play plotting this, because the past is not necessarily an accurate portrayal of what the future will be. In fact, it won't be. We will see wholesale changes across markets in insurance, but also across most industries, particularly the high carbon ones, and many of them are at the heart of our economic development. So there's a pressure growing around resilience to the changing risk. The actions that will need to be taken around that is making sure that the governance of the risk and opportunity is flexible enough to adjust to those changing market, climate, and liability conditions. That there is resiliency to physical risks, and we're starting to see some of those manifest themselves. We're not starting, they have been manifesting themselves for a number of years now estimated at something like $3.5 trillion worth of climate-related losses have occurred in the last 20 years or so. So being resilient to those physical risks, whether it's flood, wildfire, and the mitigation actions and adaptation is taking place to protect against what may be to come, where these may be even more extreme. And being able to adapt those strategies through good governance. There is already increasing regulatory pressure, the TCFD, the EU Non-Financial Reporting Directive, to name but a few. The G7 has come out in favour of mandatory climate risk and financial disclosure. And key parts of that include modelling the future through climate scenarios across portfolios, whether that's a portfolio of assets as a corporate or portfolio of investments and underwriting, whether you're a financial institution. And latterly, that will also include requirements to see what your transition plan is aligned to Paris. Capital markets, as Liz has very, very expertly summarized, are withdrawing from fossil fuels, and we can see that this will only continue and start to impact other sectors that are reliant on fossil fuels. And we're seeing a whole swathe of divestments, mergers and acquisitions, but also we're seeing increasingly not just markets withdrawing from traditional fossil fuel investments, but also starting to ramp up their investments and wanting to find projects in green and transition finance. And we may see some linking of that finance to actual metrics, KPIs, targets, and performance. And finally, there is also markets are changing, public pressure, reputation is also changing. There is a desire to see up and down supply chains, value chains, a decarbonisation of the products and services as well as operations, and that these plans are informed not just by economics, but also by science to meet climate and social justice objectives as well, which are all part of the Paris Agreement. So a risk manager can classify the risks. And as I said, the risk manager is crucial to being able to plot what this world will look like through to enable that strategic decision making. There are three types of climate risk that the risk manager needs to address. There is the physical risk, the risk from the climate onto the company. And that can be acute, change in frequency and severity of events, floods, typhoons, wildfires, for example, but also chronic as sea level rise grows, and also rising temperatures affect productivity, both in terms of the ability of people to actually work through the hottest heat waves and also hottest temperatures, and also machinery to function. There are also in some areas of the world wild fluctuations that they may actually experience more severe cold spells in winters as well. Second risk is transition. And this is really the risks and opportunities, and particularly the opportunities also that arise from the market changing to a low carbon market. And really this comes across from changes in policy, technology, societal pressure, and consumer preference. And I would say also in terms of customer preference, this can also manifest itself through large organizations trying to push down their supply chain to help them meet their own climate goals. Some sectors will face big shifts in asset values. We're already seeing write-downs occurring in the Australian economy on certain assets. We've seen this across the world, and increasingly we're seeing some assets that 2 years ago had a very good business case are already being seen as potentially stranded because the finance is not there, because corporates and finance are starting to go, actually, is this a project we want to be a part of because of its impact on our reputation, on our share price, on the investor pressure. So that's a transition risk. but there are opportunities. There will be trillions invested into new infrastructure, whether that's green hydrogen production, into new energy systems. So we will see a new agricultural ways of doing things that reduce the emissions from agriculture. The final one, which is really growing fast from a relatively low base, is the liability aspect, which is if physical is what the climate does to us, like transition is what we do in response and to preempt and prevent the worst excesses of climate change, then liability is really who do you hold accountable. And this is really starting now. We're seeing across the globe, huge rise in litigation cases that are inside and outside of court. Most recently, Shell lost a case in the Dutch court under tort law, which requires it to actually reduce it, to increase its emissions reduction targets from about 20% to 45% by 2030. And we're seeing also state, cities, regions, individuals taking corporates to court on this. In Australia, we saw a successful out-of-court settlement with one of the major superannuation funds, forcing them to have a much stricter climate strategy, and we're also seeing some other cases in Australia as well. So new areas of law are also being developed, and this also impacts into the insurance market, with some types of insurance also not being excluded, of some clauses and some causes from climate change being introduced as well. So Liz, handing back to you, talking about the insurance and what tools are out there to help.
Thank you, Tony. Thank you very much. So as we can see, there are certainly challenges ahead. And for us to combat these challenges, we really do need to pull together and work collaboratively so that we can create really innovative solutions and move forward in a positive way. And I wanted today just to briefly talk through an innovation project that I personally have had the honour of leading for the past year and a half. And it is focused on creating that continued access to insurance capacity and capital for high organisations that are committed to a low carbon future. The solution that we've created is called Climate Transition Pathways, and Tony referenced it at the beginning of the presentation. And as Willis Towers Watson, we see our role with this as incubating an industry standard for financial services. So this isn't a solution that's just open to our clients, excuse me. This is a solution that's open to the entire industry, to all brokers, to all insurers, and to all financial institutions, because it's needed, because there needs to be a consistent approach and a solution so that organisations can have continued access to insurance capacity and capital. So what we've created is an accreditation framework, and this assesses a climate transition plan. So an organisation's climate transition plan to see whether it's aligned with the Paris Agreement. So it's really giving it a rubber stamp to say that this organisation has a robust climate transition plan. And this will allow insurers and financial institutions to be able to identify those robust climate transition plans and create engagement strategies with industries. So rather than them feeling that they've got to go down the divestment route, which we're seeing now, and with thinking about that domino effect and how that's going to cascade across multiple high carbon industries, how is that actually going to work in reality? That could really be catastrophic for our economy. So this is a way that they can identify those organisations committed to the climate transition. So this helps them with their roles as stewards of the climate transition, as we discussed earlier, rather than them taking this exclusion strategy and saying that they're just not going to support certain sectors and high carbon industries. And it also gives the high carbon organisations peace of mind that as they go through their transition journey, they're going to have continued access to insurance capacity whilst they're transitioning, and also debt finance to be able to fund the transition that's going to be needed, which obviously is fundamental. So the way that this works, we've partnered with a third party called CDP. the Carbon Disclosure Project, they already have an assessment methodology to assess climate transition plans called ACT, A-C-T. And we also set up an independent accreditation committee. So this isn't an accreditation that Willis Towers Watson is giving. It's really important that this is an independent accreditation for the industry. So we launched this accreditation committee in May, and we've got 2 third-party organisations on that committee, Volans, who set up the think tank Bankers for Net Zero, and CBI, who are the Climate Bonds Initiative. So these are 2 organisations really committed to net zero initiatives for financial services, who can see the benefit of climate transition pathways as a solution that can help really drive and accelerate that low carbon transition. And the accreditation committee are going to be using 5 key principles that underpin the accreditation to assess whether the climate transition plan is aligned to the Paris Agreement. And Tony has been heavily involved in this project in developing those principles. So I'll just hand back briefly to Tony just to talk through those principles.
Yeah, thank you, Liz. As Liz said, there are 5 principles. These haven't been created in a vacuum. In fact, they've been heavily building upon the shoulders of a lot of work that's been developed, both through the Climate Bonds Initiative, Credit Suisse, but also some of the other initiatives I mentioned earlier. And those 5 principles are really trying to sort of articulate what good transition plans look like that are aligned to the transition goals of the Paris Agreement. And it's important because a lot of the nervousness in the market is driven by the fact of not being actually able to understand or differentiate between greenwash, i.e. where companies are sort of putting a green wrapper against business as usual, and actual plans and implementation that really drives a decarbonisation in their organisation and also into the wider economy. So those 5 principles, 4 of them look at forward-looking metrics. The idea is that it doesn't really matter where you start from in terms of where your carbon emissions are. It's the direction of travel and the alignment to Paris that's important. Those first 4 metrics are that you have short, medium, and long-term goals and that align to the Paris Agreement, that they are informed by what the science tells us needs to be the rate of decarbonisation and maintaining carbon budgets to keep to the Paris Agreement, that the pathway that you choose and the goals that you have within that decarbonisation are generating meaningful decarbonisation within that pathway, and that it isn't just a question of offsetting your way to zero emissions. And then finally, the final forward-looking thing is looking at technology and asset deployment, as well as business plans that you're actually implementing and will be implementing to show that actually there is some substance of what you're actually planning to do behind it. So those are the 4 forward-looking. But the accreditation itself is not just a one-time only accreditation, and then you get it for life. You have to demonstrate that there is performance against those plans. So the 5th principle looks at the operating metrics and the transparency of your performance as well to determine whether you're actually keeping to that pathway. And that will also be underlined with an annual assessment behind the accreditation. So you may get it in the first year, but if you don't meet those plans in subsequent years, you may fall off the accreditation as well. So those are the 5 principles behind it. There is a lot of a deep depth to the ACT assessment, which you can find online. It's an open source framework that's been developed with industry and in consultation with industry. It goes into things like targets, your CapEx investment in real assets, in R&D, your engagement up and down the value chain, your management, your business plans, and your engagement in the policy arena as well. So that's a high-level view of it. You can find out more at the website at the bottom, climatetransitionpathways.com as well. And I think it's really, we're really excited because we've also seen the first of insurer open market capacity behind it last week. And I know Liz is really excited about what might be coming in the future as well from that.
Thank you. Thank you ever so much, Tony. So where an organisation has a Paris-aligned climate transition plan, they would get that CTP accreditation, which then would be like a passport that would unlock continued access to insurance capacity and capital. So we launched the accreditation committee in May. We're now looking at building out an insurer industry solution for electric utilities and oil and gas, because obviously this is an acute area that needs support. And as Tony said, we're really delighted that Liberty were the first insurer to publicly announce their support for CTP last week, and they will be supporting that electric utilities and oil and gas solution by aligning capacity to it. And we're also in discussion with all the key markets, as you can imagine. And the markets are really interested in this because they need a solution to be able to continue to support organisations within these industries, but also support the low carbon transition. And they see CTP as that solution. So we're expecting in the next couple of months to be able to announce other insurers that will be supporting CTP. And we're not developing this in a vacuum. We were also involved in a number of working groups across the industry. And just to mention one, both Tony and I sit on the Lloyd's Sustainable Markets Initiative working group, where we're looking at the framework needed for insurers, and we're looking at CTP's applicability for that, so that we have this consistent approach across the industry, which also will help you as risk managers, so that you can see what insurers are going to be needing for you to be able to access capacity for the future. So I'd like to close now and just briefly circle back to where we started. And I just wanted to talk about where Blockbuster is now, because I found this quite interesting when I was doing some research. It was interesting for me to learn that actually there is still one Blockbuster store that's in existence. I was surprised actually about this. It's based in Oregon in America, and it's actually an Airbnb. And I mentioned at the beginning that I like a disaster movie. And for any other disaster movie fans out there, I'm sure that you'll be aware of the common thread that runs through all disaster movies, and that is that they all start with people not listening to the scientists. So I think we really do need to work together, and by doing that and working collaboratively, we can ensure that your organisation doesn't end up like Blockbuster, and we can also ensure that none of us end up in a real life disaster movie. So I hope that you found this thought-provoking, and it would be great if we could take any questions that you've got. So maybe I could hand back over to Matt to take any questions. Thank you.
Thank you, Liz, and thank you, Tony. Great presentation, very informative. And we've immediately got in our Q&As a couple of follow-up questions on the climate transition pathway. So I'd like to start with those as it's sort of nice segue from the last slide there. Anthony Chung has asked whether, assuming that a company's goals are aligned to the Paris commitment, does the climate transition pathway option create access to insurers that have already walked away in the past due to their thermal coal policies?
I'm happy to take that, Matt. We're in discussions at the moment with a number of markets. If I'm going to be honest, I think it's unlikely that insurers are going to come back if they've taken a really draconian view, because I think reputationally it will be very difficult for them to do that. But I can't say categorically that won't happen. It will be down to their individual strategies to see whether they decide that they want to do that. But certainly this is about securing capacity that's available now for the future. And I do think that there will be some from discussions that we've had with markets that maybe have taken more of a mid-ground view that could then take a much broader open view where there is CTP. So I think that's the piece that's important. And thinking about this cascading across other industries, I think this is also key. So having the conversation with insurers now about industries that they're continuing to support now, but potentially won't be supporting in the future, this is important, because this is a way that we can secure that capacity now for those industries.
Lovely, thank you. Now, next question has come in. Why would companies use transition pathways approach over using the Science Based Targets initiative? I think, Tony, I might aim this one at you.
Yeah, I don't think it's really an either or. One of the key metrics that we look at is whether a company actually has a science-based target, whether that's been approved by the Science Based Target Initiative or not. But that would certainly aid in understanding, because that's already gone through a rigorous process of being aligned to the Paris Agreement. So it's not really an either or.
Fantastic. And I might stay with you while you're on the stage. Has Willis Towers Watson looked at the impact of international carbon border adjustment mechanisms and potential risks to transition plans and insurability of carbon price risk?
So that's not necessarily at the heart of what the climate transition pathways will be looking at. In many cases, I think carbon pricing itself arguably will be passed through to customers. So it's difficult to see actually, without the details of that mechanism, how it will impact the transition plans. What I would say is, if you have a robust transition plan in place, that is surely going to help you over time overcome the mechanism which to be able to trade through the International Carbon Border Adjustment, because that is set up to try and sort of set a level playing field for those companies that are low carbon versus those that are high carbon. So if you're actually having a transition plan and you're acting on it and you're decarbonizing it, then that mechanism will start to sort of even out anyway, and you'll be in a direct competition and you won't be facing that pricing mechanism.
Okay, Tony, and there's one, I'm going to jump Matthew Wild's question, we'll come back to it, just because it will stay on the theme of the climate transition pathways, the accreditation of 5 principles. What does the assessment of plans look like? Is it an annual review or milestone driven based on specific plans? Are you able to answer that one, Tony? Oh, okay.
Yeah, so, yeah.
Sorry, we're fighting over the answers here now.
No, Liz, you go first. I've answered a lot.
Okay, no, thank you, Tony. So CDP, the Carbon Disclosure Project, are the party that do the actual assessment. This is an annual assessment that will be looked at. And it takes between 4 to 6 weeks, dependent on the complexity of the organisation initially. It wouldn't be that long, obviously, each year, but for the first one, it would. And they're looking at 3 key data sources. So they're looking at publicly available data, they're looking at third-party databases, and then they're working with the organisation itself to ensure that they've got the information needed to be able to create the assessment. It's a real deep dive assessment, so it's a very robust assessment that is provided there. And the accreditation then, so the assessment then goes to the accreditation committee, and the accreditation then is using those 5 key principles that Tony spoke through and mapping that assessment to those principles to see whether it aligns with the Paris Agreement. And that accreditation would also be an annual review to make sure that the organisation is on the right trajectory, so that they're doing really what they said that they were going to do in their strategy. Maybe I can pass over to you, Tony, if there's anything else you wanted to add.
Yeah, I think the way to sort of also answer it is I'd urge you to go and look at the ACT Initiative website, because you can get a deep dive into the methodologies there, the indicators that they look at, and obviously we'll be publishing more and more about what that mapping to the principles will be in the future as well. So, but yeah, Liz has articulated exactly how this will go. It is a deep dive first off, and we didn't anticipate the operating metrics and the annual reviews to be perhaps not as deep, but it really depends on whether you've enacted a lot of change to your strategy, to your transition plan, to your organisation over that time period, on how deep that will need to be.
I'm going to come to a detailed question with Matthew in one sec, but just a quickie for me, and it's a question that came from another audience member offline. Do you think there'll be more favourable rates of insurance for high carbon companies transitioning to low carbon? It all feels a bit like there's a bit of stick for the last couple of years with thermal coal, or we're reducing our capacity, we're coming off risk. Now there's talk about more of a carrot approach, using an accreditation service. But what does that look like? Does that mean more capacity and cheaper rates for those that are doing the right thing?
I'm happy to take that, Matt. I think it's a very interesting question. And I think when you look at sustainability linked loans, I think it gives us a clue around the answer, because they are differentiating their rates dependent on whether targets are being achieved. So we could anticipate that there will be rate differentiation. But I would expect that rather than reductions, I think you're probably going to, you can preempt what I'm going to say, we're going to see increases for the organisations that are not doing the right thing. So I think that is going to be the impact. And I think this isn't just about rate. It is really important for us to understand here that this is about access to capacity, full stop. If people don't go in the right direction, then there will be some industries that potentially are going to be left high and dry without capacity. So it's not just about the fact that it's going to be expensive capacity, it's about the fact that there won't be capacity. And that is why this is so important.
So there may be a carrot, but there's still a damn big stick out there at the moment. So thanks for that. Question for Matthew Wild. Let's get to Matthew's question, a two-parter. With only 12% of worldwide losses from flooding insured since 1980, despite it accounting for approximately 40% of all Nat Cat losses during that same time frame, plus the increasing frequency of events due to the impact of climate change. Firstly, do you think more needs to be done from a government policy and governance standpoint to combat the lack of insurable losses? And secondly, how can businesses better prepare for those physical and transition risks relating to this particular peril and ensure access to capacity? So who would like to start with the first part?
Well, I was going to start with the second, so I will give the first part to you, Tony.
Yes, is the short answer. Do you think not more needs to be done on government policy? Yes, there is. I mean, having said that, I mean, in many jurisdictions, there already is quite a lot that already transfers to sovereign already. You can see that in the UK with Flood Re, which is a government-backed insurance policy anyway. But yeah, this is an ever-evolving space. I think also there needs to be more policy around actually where you can't build, because you're just setting yourself up for a fall if you do. The risks are changing on flood, on fire, on storm damage as well. And they are going to increase. And what also could happen more often is the frequency of those are such that the likelihood of multiple events happening, it's called flocking of green swans or even black swans, could happen as well. So it's not just the fact that you get one particular event, but then you get a multitude of them. I mean, we've seen this across the world where also you've seen flip-flops in the climate between extremes of drought to flood, to severe cold conditions. Texas in particular has been very, very hit by this, where they've had even sites going offline, like 13% of the refining capacity for the US went offline for 3 weeks following this, the hurricanes and the flooding that happened through a sequence of 3 hurricanes that hit that coast. So yes, I think governments need to do more.
And Liz, the second part?
Yeah, no, I'm happy to pick that up, Matt. I mean, Tony obviously spoke through those 3 key areas that risk managers need to look at when we're thinking about climate, and physical risk was number 1. So I think really understanding your physical risk, it's going to be key. And one of the things that you can do is actually we have the ability to model different climate scenarios and how that might impact your organization. So I think that is something that definitely could be done, so that you can see that dependent on the rate of global warming, you can see how that could affect you from a physical risk perspective. So I think knowledge is power. I think understanding what those risks look like is really key for you, because then you can create a mitigation strategy. And also part of that is your risk transfer strategy, but it's not just your risk transfer strategy. So I think just understanding that physical risk is really key.
Perfect. We're getting to maybe the last one or two questions. So what's your take on the fact that organizations, insurers and reinsurers, have started to invest in green energy ventures to secure their returns in the long run? And what does this mean? But does this mean they are closing their eyes on the current situation where they can play a big role in persuading other organizations and governmental bodies as well to make a faster and hard switch to their resource exploitation? I would like to take that one, Tony.
I'm happy to start and then maybe turn.
Okay,
sorry.
Fighting over
yet again. I mean, I think, Tony talked about the opportunity that's here. And I think that the green energy piece is certainly an opportunity for insurers. And I think that they see it as such. But I think, as we were talking about, the industry understands the important part that they have to play. And they are lagging behind financial institutions to a certain extent, but they're starting to catch up. And I think things like the Lloyd's Sustainable Markets Initiative, the Net Zero Insurance Alliance, I think we can see that the industry is really recognizing that they do have a really key role to play here. And the key thing here is that they work together, that they don't take siloed approaches, but they work together as an industry to drive the change that's needed. Sorry, Tony, maybe I can pass to you to add anything extra.
I think you actually articulated it fine.
So let's move to one more question. We've got 2 minutes. Do you think there could be a shift towards more different types of insurance products like parametric insurance? Agriculture are adopting that at the moment to address future climate risk events scenarios and gain better coverage.
The answer is yes, Matt. Yes. Definitely, we are seeing more and more clients who are interested in parametric solutions. So yes.
Yeah,
I think the only thing I'd add to that is that we may see insurers also, if they are taking a stewardship approach, maybe putting conditions on what that money is used for, and that to build back more resilient, to build greener infrastructure, and not just to build back exactly what was there before, if it isn't deemed to be aligned with a resilient climate future, whether that's mitigation, but also physical risk as well.
Fantastic.
I think that's a really good point, Tony. And definitely from the conversations that I'm having with insurers, you can see that they're looking at the innovation that they need to deliver around so-called green products. And some of that would be around the wording as well, so that they could build back greener.
And a quick question's coming at the end. Duncan, I'm going to just pass on you for the second, but just Hedel Palmer's asked the question, if a company is on a path to transition to be net zero, and if it falls short in terms to changing all its processes and decides to purchase carbon credits, would that count towards accreditation? Interesting question.
I think it's really hard to make a general answer to that, because you'd have to see the detail of how big that is anyway. But at the heart of all transition plans is the strategic question. How are you a profitable business in a zero carbon world? Yeah. That's what you've got to actually think. And I would also say offsets. It's a real minefield at the moment, and we've seen several offsetting schemes destroyed in wildfires. So actually, the value of purchasing those offsets may not actually deliver what you need. It may be money wasted, and they may also count against you in the long run. So I would urge you to use offsets only for that final few percent if you cannot get it down to zero, and really not think about offsetting as a core part of your strategy, because that is really not going to achieve the Paris goals. But also under the transition pathways, we do try and emphasize that offsetting is not the way to a zero carbon pathway. Now, I appreciate that for many companies, it's also going to depend on how the infrastructure around changes, what the market dynamics as well. But that's also part of why you need a good risk manager looking strategically at these risks and being able to sort of see how the changes in the market potentially could change the financial position of the company.
Liz, Tony, thank you very much for the excellent presentation, and to the audience for their question and answers, or questions and your answers. I think it's come a long way since my experience at RIMS in 2018 to where we are at RIMS Australasia in 2021. Gosh, no, who knows what's going to happen in the next 2 or 3 years. Fantastic exchange. I'll hand back now to our RIMS organizer, Trevor Cuthbert. Thank you.
Thank you, Matthew, and I echo all those thoughts. I've just found out that a drawback of being a presenter is you can't ask questions yourself. Yes, I'd like to thank Liz, Tony and Matthew for a wonderfully informative and thought-provoking session, which, as you could see, we got more questions than we had time for, which was excellent.